Join me as I dive deep into the challenge of figuring out how integrity can actually unlock the secrets to creating real wealth. Here is the uncomfortable truth most people miss. Over almost 3 decades, companies known for high trust, high integrity cultures compounded stock returns to roughly 3.5 times their peers. Integrity is not a feel-good slogan. It is a wealth engine. And by the end of this episode, you will know exactly how to turn it into your personal unfair advantage. Let us set the frame. When I say integrity, I am not talking about perfection or virtue signaling. Integrity is alignment. It is the gritty, day-by-day consistency between what you say, what you do, and what you allow. It is keeping promises when it costs you. It is telling the truth when the truth is expensive. It is honoring agreements when nobody is watching. In markets, that alignment compresses risk, increases speed, and expands opportunity. That is why integrity pays. Now, the problem. So many wealth journeys stall because we chase shortcuts. We copy trades without understanding risk. We sell things we do not believe in. We underdeliver. We cut corners on taxes or compliance. We burn bridges, and then wonder why new bridges are not appearing. Shortcuts feel like speed, but they quietly install a tax on your future called the risk premium. Every corner you cut inflates counterparty risk, legal risk, and reputation risk. Your cost of capital goes up. People move slower around you. You lose access to the high-quality deals that only trade inside trusted circles. That is the real price of misalignment. Let me make that concrete. Picture 2 creators building the same business. One plays the like and leave game, exaggerated claims, hidden fees, missed deliverables, ghosted emails. The other plays the long game, clear scope, documented expectations, on-time delivery, clean books, immediate make-rights when something goes wrong. On paper, they might start at the same revenue. But the second creator builds a trust dividend. Vendors offer better terms. Clients accept higher retainers. Partners reply faster. Lawyers shorten contracts. Bankers give friendlier credit. Customers tolerate the occasional miss because they believe the intent is clean. Over time, that dividend compounds into wealth. Here is the hidden math of integrity. Integrity lowers friction. Lower friction raises throughput. Higher throughput with the same resources is operational alpha. That alpha stacks on top of your financial alpha. And when your name equals reliability, you begin earning an opportunity yield on your reputation. People bring you deals you did not ask for. That is the flywheel. So how do we build it? Let us explore 5 levers that convert integrity into wealth. First, promise precision. Do not promise outcomes you do not control. Promise the process you will run, the standards you will uphold, and the worst-case actions you will take if reality resists. In trading, that looks like publishing your risk rules before you publish your results. In consulting, that looks like defining deliverables with acceptance criteria, not buzzwords. Precision protects trust when outcomes vary. Second, truthful positioning. Sell what you can defend in an adversarial room. If your claim cannot survive a skeptical auditor, it is a liability dressed as marketing. The wealthy learn this the hard way. Mismatched claims produce refunds, chargebacks, regulator headaches, and reputational drag. Truthful positioning, by contrast, attracts the right client, reduces post-sale friction, and protects margin. Third, make right reflexes. Things will go wrong. Integrity is not the absence of error. It is the speed and completeness of your repair. Proactively disclose. Overcorrect. Compensate without haggling. Narrate the fix so the other side hears the lesson learned. Every make right is a trust deposit. And deposits compound. Fourth, clean ledgers. Wealth loves clarity. Keep tight books. Timestamp your decisions. Write memos explaining why you did what you did. Separate client funds from operating cash. File taxes early. When your paper trail is clean, capital becomes cheap, auditors become allies, and partnerships start on day one with confidence instead of caution. Fifth, relationship governance. Draft simple, standard, fair agreements. Cap downside for the other side. Build clear exit ramps. Define dispute paths up front. High trust players are not casual about contracts, they are considerate. Considerate contracts widen your deal flow because people feel safe saying yes. Now let us put flesh on these levers with stories. Consider the investor who refused a glamorous allocation because the founder dodged one straightforward question about related party transactions. He walked away. 2 years later, the company imploded over those exact undisclosed deals. His integrity did not make him poorer. It preserved optionality for better bets. That is opportunity cost reclaimed by values. Think of the retailer that chose to protect employees and customers during a crisis, absorbing short-term margin pain to avoid long-term brand damage. Staff stayed, customers stayed, suppliers extended favorable terms. The stock recovered faster than peers because markets trust businesses that do the right thing quickly. On Wall Street, time to trust restoration is a hidden metric. Integrity compresses that timeline. Or take a freelancer who refuses to pad hours. She ships early, documents everything, and never surprises the client on price. Within a year, she is not selling. She is taking orders. Referrals arrive pre-closed because her clients sell her for her. That is the compounding effect of integrity in a micro-business. Zoom out, and you will see the same pattern in large enterprises. High-trust cultures enjoy lower churn, lower recruitment cost, higher innovation rates, and faster cycle times. Those are not soft perks. They are hard drivers of free cash flow. When your organization does not waste energy surviving politics and cleaning up avoidable messes, it converts more of its gross effort into net progress. Speed with accuracy is a competitive moat. Here is the key moment. Integrity does not just make you liked. It makes you legible. When you are legible, risk holders can price you more accurately. That lowers your discount rate. In finance speak, your future cash flows are worth more today. In human terms, people trust you sooner, sign faster, pay up front, and forgive honest mistakes because they can predict you. Predictability is an asset class. Let us break down the mechanisms one by one. Mechanism 1, counterparty confidence. Every deal has a shadow deal layered beneath it, the deal about the deal. Will you communicate if something slips? Will you deliver the not glamorous parts? Will you protect sensitive data? Integrity reduces the variance around those answers. Lower variance lowers the contingency buffers the other side builds into price and terms. Better terms mean more money left on your side of the table. Mechanism 2, cost of capital. Banks, investors, even your future self price your behavior. Late filings, messy reconciliations, aggressive claims, these things widen spreads. Clean governance narrows them. Narrow spreads compound. Over years, a slightly cheaper cost of capital is worth more than one viral campaign. Mechanism 3, operational throughput. Integrity eliminates internal drag. You do not have to hold emergency town halls to explain why a shortcut backfired. You do not waste hours rewriting history in Slack or email. You iterate. You ship. You learn. Throughput is the boring superpower that turns discipline into dominance. Mechanism 4, network effects. The highest quality opportunities are not posted publicly. They travel along trust lines. Integrity electrifies those lines. Individuals who protect their partner's interests get invited deeper into circles where asymmetric upside lives. In plain words, do right by people and your deal flow upgrades. Mechanism 5, regulatory resilience. Mistakes will happen. But regulators, platforms, and counterparties treat transparent, proactive actors very differently from evasive ones. If you behave like a steward before you are supervised, you build goodwill that matters when the heat arrives. Now, some uncomfortable contrasts, because depth requires comparing first-order wins with second- and third-order losses. Shortcut number 1, gaming testimonials. First-order win, boosted conversions this month. Second-order loss, chargebacks from missold customers. Third-order loss, payment processors flag your account, raising fees. Net effect, your true customer acquisition cost creeps up, and good affiliates refuse to touch your links. Integrity would have sold fewer but better fit customers and raised lifetime value. Shortcut number 2, aggressive tax evasion. First order win, more cash now. Second order loss, anxiety and distraction, lower creative bandwidth. Third order loss, risk-adjusted return craters when a notice lands. Integrity pays taxes cleanly, sleeps well, creates more. Shortcut number 3, over-promising to close a deal. First order win, you win the signature. Second order loss, your team burns out closing the gap. Third order loss, the client never buys again and tells 5 friends to avoid you. Integrity would have negotiated scope, kept morale intact, and grown the account. Let us switch gears and make this personal. How do you operationalize integrity this week so it starts paying you next quarter and compounding for years? Step 1. Publish your rules. Write a 1-page operating covenant for yourself or your business. Include your non-negotiables: how you sell, what you refuse to sell, what you do when you are wrong, how fast you communicate, and how you treat money that is not yours. When rules are written, your future self has less room to rationalize convenient exceptions. Step 2. Build a promise ledger. Keep a visible list of commitments made and their due dates. Review it daily. The wealthiest people you admire are usually not the smartest. They are the most reliable. Reliability is a learnable habit tracked one promise at a time. Step 3. Upgrade your disclosures. Before the other side asks, tell them the constraints, the risks, the edge cases, and the fallback plans. Paradoxically, disclosing risk early closes more deals because you become the rare player who is not hiding the fine print. Step 4. Calibrate your claims. Replace adjectives with evidence. Fast, premium, and world-class are empty calories. Show your process, your benchmarks, your turnaround times, your retention rates, your refund policy. Evidence earns trust faster than adjectives. Step 5. Ritualize make-rights. Pre-authorize yourself to over-deliver when you under-deliver. Decide now what you will comp, how you will communicate, and what artifact you will produce to prove the fix. Rituals turn good intentions into automatic behavior. Step 6. Audit your circle. Integrity is contagious, both ways. If you tolerate casual lying, slow payment, and quiet exploitation in your network, you are broadcasting your own standards. Tighten your circle and watch your opportunities clean up. Step 7. Codify fair contracts. Standardize clear human-readable agreements. Add specific exit ramps. Include a shared definition of done. Integrity is easier when the paperwork helps good faith people succeed. Now, a word to traders, founders, and professionals who live by performance numbers. You will be tempted to think, results are what matter. If I win, who cares how? But the market does care, because the market prices future cash flows. And the surest path to high durable cash flows is trusted relationships protected by consistent behavior. That is why integrity scales better than talent. Talent wins games. Integrity wins seasons. Here is a mental model I use. Imagine that every interaction leaves a residue in your reputation account, positive or negative. Integrity maximizes positive residue per interaction. That residue attracts allies. Allies create leverage. Leverage manufactures wealth faster than hustle ever will. If you feel like you are pushing a boulder uphill alone, check your residue. You might be leaking trust without noticing. Let us land this. Integrity does 3 things that directly create wealth. It lowers your cost of capital by making you predictable. It increases your operational speed by reducing internal drag. And it amplifies your opportunity set by opening doors that only unlock for trusted names. Those 3 together are why people with average talent and exceptional integrity end up compounding past people with exceptional talent and flexible ethics. So, what do you do next? Decide one promise you will keep this week, even if it hurts a little. Send one proactive disclosure before anyone asks. Clean one messy ledger entry. And repair one small thing you broke without being asked. That is how the flywheel starts. Small, honest actions, repeated, become a brand. A brand is a magnet. And magnets pull wealth. If this resonated, Tell me one situation where integrity cost you in the short term but paid you later. Your story will help someone else take the harder, better path. And if you want more deep dives like this, no fluff, just frameworks that work, explore the other episodes. I am building a library for people who want to win without losing themselves. Because real wealth is not just what you stack in your accounts. It is who you become while stacking it.